Greeting everyone. My name is Ph.D. I'm a student of Executive MBA, class of September 2023 from IPMI Business School, Jakarta. Today, I would like to share with you a video about the mind mapping on corporate finance.
Before I continue this video, allow me to introduce our distinguished and beloved lecturer, Professor Roy Sembel, which already gave us a very valuable and also very attractive course. This is my colleague. In the beginning of class, Prof. Roy gave us a huge question, up until 50 questions, that we have to at least 80% can answer. This is the contents of the course.
In the first chapter, we discuss about financial management. What is the goal of financial management? The goals of financial management is divided into 4 sections. In the first section, it discusses about how to maximize profit, how to maximize wealth of the company. Second section, about operational objective. We discuss about timely availability of requisite finance, most effective utilization of finance, safety of investment, and the last is about the growth of the enterprises. On the section 3, we discuss about timely payment of the interest, payment of reasonable dividend, timely payment of wages, fair settlement with suppliers, timely payment of taxes, and the important thing is about maintaining good relation with financiers or investor. The last section discuss about conduct researching into the new and better sources for the finance. Top of this fourth section about the goals of the financial management is about value creation. What kind of value creation? Is about the value creation which have a significant and also sustainable. We continue our discussion on financial management. Now we discuss about what to manage in the financial management. First thing is about capital structure. In this issue, we discuss about the debt to equity ratio to evaluate the wealth of the company. The next one is about working capital management. We discuss about the current asset and also the working capital. The next one is about asset structure. You can analyze this fixed asset ratio to detect or to identify or to analyze the wealth of the company. The next thing is about revenue management, whereby the emphasis is how to get a maximum portion of recurring revenue. Next thing is about cost management. It's about the fixed cost proportion, and then it's about the cash flow management. We emphasize on 5 principles of cash management, and following by conducting in-depth about the growth management, we can always discuss about the organic merger and acquisition as well as partnership. The last thing is about risk management. The important thing is about risk appetite. Next, on financial management principles and essentials, we have 4 cornerstone of corporate finance. Number 1 is about core of the value principle. The value of the company is driven by the growth or the return on capital, growth, cash flow. The second one about the conservation of value principle, that we cannot create value by rearranging cash flow. Next, the third is about best owner principle. Business value depends upon the owner capabilities. The last thing on this 4 cornerstone of the corporate finance is expectation of treadmill principle. What is treadmill principle? It is when the more we have investor request our share, it means that we must perform to keep it up. The next about the principle and essential wrote by Professor Ramcharan. It's about 5 business essentials: cash, profit margin, velocity, a growth. Then the last thing is about customer focus. If company practice or refer to this 5 business essential, the company will create a good value creation. On the other side, we also have some principle on good corporate governance. We can shortcut it with the tariff. First, T is about transparency. A is accountability. R is responsibility. I is independency. And the last F is fairness. Also, we have a principal agent problem. All of these 3 will create what we call it adverse selection, whereby somebody or a company took gain from the market or from the business uh, uh, by using others' costs or other expenses. What we can learn from these two GCG principle and also principal agent problem is that if we execute or we conduct or run the company by refer to this principle, then what we get is product management, sustainable performance improvement, and better company performance. In this occasion, I would like to discuss about the most three important thing according to the class. First is about time value of money. What we receive today, say we receive $1, is worth more than $1 in the future due to the opportunity cost. This is a certain concept that we have to be understood in the financial management. Number two is about the incremental cash flow, potential increase or decrease of the company cash flow related to the acceptance of new project or new investment and a new asset. The last thing interesting on the concept of the financial management is cash is the king. Cash is the king is the superiority of the cash over other assets or forms of payment. This is very important in order to keep our company or in the financial management to always create value for the company. Continue with framework of capital budgeting. Definition of the capital budgeting is planning process for the investment in long-term asset. What is the method? First is payback period. Payback period is how many years does it takes to cover the initial investment. Uh, some say that this method is biased or subjective because it's not considering the cash flow, not considering the rate of return, and not considering time value of money. The next thing is net present value. The short of thing that we can always accept the investment if the NPV value is more or equal to zero. So we can accept that one. The next thing is about the profitability index. The decision rule is if PI above or equal with 1, we can accept the investment. The last thing is about internal rate of return, IRR, is a present value of all cash flow divided by IO. We can continue with the concept. First is estimate future or expected future cash flow. The second one is evaluate the project based on capital budgeting evaluation. Last one is decide whether this project is good or bad. And then there are some method on the decision making criteria if we want to accept or reject a long-term investment proposal. On the section or chapter 3, we discuss about how to analyze of securities like share, stock, bonds, or other instrument, or how to analyze our investment. We can always do some evaluation and analysis on our investment or our securities in the way of passive or active. Passive means we just follow the market, and for the active, we can always conduct financial instrument evaluation. In the fundamental, we discuss about the analysis on domestic or global, about the macro, also industrial analysis. Also in the fundamental, we can evaluate the indicators available on the financial statement, like what available on the balance sheets, which usually we can derive the conclude or the net worth of the company. Second was about the income statement, whereby we can always identify or evaluate the profitability. And the last thing is about the cash flow statement. Usually, we can track down the cash movement. The other thing is we can always do some technical evaluation. We can always study about pattern in the price graph, use some method to do some technical analysis, like a momentum versus reversal, check about the trend, is it a support or resistance, if there are a gap, come on, breakaway, measuring extraction gap, and about triangle, symmetric, asymmetric, double bottom, double top. The last thing is about market sentiment, we can use evaluation on the financial instrument. This we can evaluate the return. So for the evaluate the risk, we can always do some quantitative. We can always check about macro industry firm, and the qualitative we can going deeper on the long term, short term stock selection, market timing, and else. So investment strategy, the important is return versus risk. This kind of analysis will be used by management or stakeholder to make a financial decision. The section or chapter 4 is about the capital structure. Capital structure is the particular combination of debt and equity used by company to finance its overall operation and growth. The keyword will be debt and also the equity. Debt financing is always involved borrowing a fund from other institution. Means it will be interest and we have to repay that obligation. In the equity financing, we raise the fund by give some portion of the ownership of the company. So difference between the debt with the equity. Debt, we don't have to share some control of the ownership of the company. And if the equity financing or equity, we have fund, but at some portion, we do not have to pay some funds or interest. But means we have to share some part of our ownership of the company. In the balance sheet, we can always divide into 4 quadrants. How to optimize capital structure? We can track, we can observe, and measurable. One is about tax benefit. The other thing is we have financial distress. If tax benefit, then we can always talk about the profitability. In the financial distress, we always can talk about volatility, the external factor, and so on. In the previous chapter, we talk about financial distress. In this section, I would like to share about corporate restructuring. Restructuring the corporate is when a company make a significant change to its financial or operational structure, typically while under financial distress. Financial distress is turnaround opportunity or permanent problem. In opportunity, the discussion will goes to how to do operation restructuring, asset restructuring, financial restructuring. In the financial restructuring, we can do a private workout, or at the last is about the file or legal bankruptcy. On the permanent problem, we can identify and we can evaluate on the private liquidation, or at the end of the process, we can always file for legal bankruptcy. When we talk about how to surviving and transforming our businesses, there are some concerns need to be bear in our mind. The one is stop the bleeding first on the cash flow, and then we can always do some financial restructuring, and then we can do some temporary pivoting, and to be more strategic, we always do about redefining our core business, and we can always seek some innovation or breakthrough that probably will need new ways of doing our businesses. Now we discuss about fraud risk management. In the fraud, we can always divide into 3 items. One is about the asset misappropriation, whereby it involves cash, inventory, and all other assets. The second one is about corruption, identify if there is any conflict of interest, bribery, illegal gratuities, or some economic extortion. Last thing is about fraudulent in statement, whether the statement came from financial or non-financial. In the fraud management, we always know about the fraud cycle. It's a combination of opportunity, justification, arrogance, competence, character, and needs, which become a key driver if somebody or some institution fall into some fraud. It will involve the system of the internal controls, the degree of the organizational values, for the tone from the top and tone from the middle, the code of conduct, ethics, and so on. It will involve the attitude and behavior. And the last thing is about knowledge. In the fraud in the financial industries, we know about the phrase about financial shenanigans, whereby someone or somebody or some institution will manipulate in a negative way of their financial performances. Usually by easily to detect is, say they do some shifting of the, say, current expenses or current income into earlier or into latest period, and then some record some revenue, one-time revenue that's not the recurrence, or sometimes book or record bogus revenue, and also like failing to pay the liabilities, and so on. That's why fraud risk management is very important. Now the discussion is shifting to how we can prevent, or we can have some fraud prevention. Fraud prevention we can always improve by with employee or company ethics. It's become a value of the company. The second one is write SOP include, whereby we can always include it in the SOP about the whistleblower system. The next is the important is the people. We have to train our employee to increase the alertness and awareness of the fraud. The other thing is we can improve the security protection on the software, on hardware using to run the companies. And as I said before, that we can strengthening about the whistleblower system. Whistleblower can be such an important thing in the fraud detection. So next to section 6, we discuss about corporate event analysis and some portfolio simulation given by Prof. Roy to all class member. First thing is about what is the corporate action. Corporate action is an activity that brings materials change to an organization and impact its stakeholder, including shareholder, both common and preferred, as well as the bondholder. So it's some breakthrough or some major thing to do in the organization, which will impact it to everybody, to the employee, to the company, to the stakeholder, shareholder, or bondholder. There are corporate event analysis. We can always derive into some coverage and the reporting. What is the corporate event analysis? It's like the IPO, initial public offering, the M&A, merger and acquisition, buyback, and so on. In the our period of the class, we do some portfolio simulation and some analysis on the corporate event analysis. Portfolio will be shared, should be on listed on LQ45 at the Indonesian Stock Exchange IDX, and have IPO before 2019. And with the value for each team is about 1 billion rupiah, and we have to decide whether buy or hold, and we track and also monitoring the portfolio bi-weekly. For the corporate event, we choose buyback, where the portfolio is came from BBRI, Bank Rakyat Indonesia, and in the buyback event, there are some employee stock allocation, and also we need to analyze and monitoring about the price to earning, earning per share, and other stock indicator. At the end, what we learn is how to again create value from the portfolio. So guys, we already at the last chapter. It's about the lesson learned. It's start with it's okay. It's okay to make a mistake, to have a bad days, to less than perfect. And after that, we can learn more from the mistake. So that's all for me. Bye to all of you.